Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment is Jeff Kilburg, Chief Investment Officer over at Sanctuary Wealth. Jeff, it's great to see you as always. Welcome back to Trade Talks. And it's been quite a week. Not only are we grappling with interest rates and inflation, of course, we have geopolitics front and center. But Jeff, what I think is so interesting is the magnitude of the swings to the downside and to the upside, recovering.
Well, Jill, great to be here, and what a week it has been. And yesterday was sensational. It's absolutely terrific to see the follow through today. We're seeing the equity markets move higher. But what happened yesterday? We haven't seen this in quite some time. We had a 7% swing from peak to trough in the Nasdaq 100. That's remarkable. On top of that, Jill, we saw a bear market in the Nasdaq 100. I know about 58 of those Nasdaq 100 names are already in a bear market, but the index as a whole went into bear market just for a couple hours, was down 21% from that all-time high. And sure enough, in the last trading session and a half, we have seen a nearly 10% bounce. So I think that sentiment, certainly we're in a risk-off environment with Ukraine-Russia crisis or Russia invading Ukraine. But on top of that, I think we just have such a different backdrop this year. And you really hit the nail on the head. The Fed policy, the uncertainty of Fed policy, there's just been a lot to digest. And that velocity we saw coming in the marketplace this week really brought a lot of anxiety and nervousness to the marketplace. But today, I think we're kind of going back to the fundamental story. We're talking about, the growth versus value. We're favoring value. All these different pieces are coming in the puzzle while we have seen inside of this chaos, the 10-year note kind of calm down.
Yeah. And Jeff, what's so interesting, we had pockets of volatility around COVID, but this really prolonged volatility environment we've been in since mid-November to where we are now. And it felt as if it was dialing back a bit before we started to have to contend with Russia and Ukraine. So it's almost like we've only been used to the market going one way for the most part. And now it's so different. We have retail participation. We have every app on the planet you can think of where you can get instant access to your account. So everyone's checking the movement, minute to minute, tick to tick, hour to hour, day to day, which is not typically how you think as a longer term investor. So it almost feels like the way that we're managing volatility is very different than longer term crises that we have in the past.
You're absolutely right. And typically, or historically speaking, you see a lot of geopolitical tensions. They see an initial sell-off, a knee-jerk reaction, it gets priced out. But what's different about this year, to your point exactly, we did see a suppression of volatility when the Fed expanded their balance sheet. We saw the money supply in January 2020 at about 15 trillion expand up to 21 trillion in November of 2021. So all this money flying around has created a little different backdrop. One of the things that's underappreciated, I think, in the marketplace going into 2022, as we expected higher volatility, no one really saw the hawkishness, or at least the rhetoric coming out of the Federal Reserve to transpire after our nice little Santa Claus rally. But the one underappreciated component is that we're in a midterm election. Jill, if you go back 85 years, the volatility that's inside of a midterm election year is persistent and consistent these first three quarters until we have a better idea of what type of turnover. Maybe the House does turn over, but we're not going to know about that until October, November. So there's just so many inputs right now in the Russia-Ukraine intense velocity that was injected in the marketplace, really caught some people off sides. But I go back to the fact that what's been the biggest risk to investors or traders from 2020 pandemic, 2021 recovery, Omicron, Delta variant, all these different ebbs and flows. What's been the biggest risk? It's been not invested. And that's evident in these last two trading sessions. If you got caught off the sideline or you sold in the hole, the market has been so volatile. And it's critical to remember, you remember this from all your volatility days here in Chicago, volatility is not a bad word. Volatility makes markets go down, but volatility also makes markets go up.
I mean, look at the opportunities we had in March and April in 2020 with our 401ks acquiring shares so much less expensive, and look at the valuations that we've just experienced in the past couple of months. But Jeff, back to our volatility days, there's always a way, particularly options traders are typically positioned into weekends. With a situation such as this, besides the anxiety around the human toll that this is going to take in Russia and in Europe, how are traders, or how do you think traders may be positioned over the weekend? I mean, we could trade more 24/7 now than we did in crises past, but it's got to be tough to keep something on.
It is. And I think you've seen risk premiums come down towards the end of the week here. And that's kind of in the wake when President Biden talked about the sanctions, the additional potential sanctions they have, but also kind of waiting. His response was that they were going to wait a month. A month seems like forever to see how these sanctions work. So we're not going to underestimate President Putin. But again, I'm not a political forecaster here. We're just trying to, from a risk perspective, a trader perspective, we're not wildly upset about where we are in this cycle. And again, we go back to all the geopolitical tension, all the geopolitical events we've seen in the last couple of decades. They get priced out pretty quickly. And the typical 6-month return, if you look at whatever geopolitical tension you want, Jill, for the last couple decades, the typical 6-month return after that event is 6%, and 12 months after that is 9% on average. Of course, the past is no way to predict the future, but I think the way we look at, and this is by no means diminishing what's transpiring in Russia, or I should say in Ukraine, but the material impact of how does that affect U.S. equities. Look at stocks today like Johnson & Johnson, 3M. We're seeing a big focus on quality and value, and that's in stark contrast to the growth story we've seen for the last couple of years.
All right, Jeff, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.